Good morning, everybody. It is Monday, September 15th, 2025. I'm Herb Morgan, Senior Managing Director and Chief Investment Officer here at Cantor Fitzgerald Managed ETF Portfolios. This is my weekly economic and market commentary. As a reminder, you can follow me intra-week. If I have something to say during the week, it'll be on LinkedIn, Herb Morgan, or X at Herb W. Morgan. This presentation has been prepared by me for use with you. Whether you are a financial advisor or an individual investor, it matters not. Everything in this should not be treated as investment advice, not tax advice, no recommendation for the purchase or sale of any securities. It's strictly for informational purposes. There are no recommendations for any trades. The opinions are mine and mine alone and do not necessarily represent the views of CFIA's parent affiliates or other portfolio managers at the firm. Pretty good week if you were in large cap U.S. equities, up 1.6%. Big cap tech rallying strong on rate cut anticipations, earnings expectations, but mid and small cap stocks actually gave back some last week, as you can see there. International markets led by emerging remained very, very strong. Fixed income continued to catch a bid. You can see the aggregate bond index up 41 basis points as the U.S. 10-year Treasury approached a yield of 4%. As we all know, the Fed meets this week, Tuesday and Wednesday, with a rate announcement on Wednesday. Treasuries gained quite a bit, 1.5%, bringing their year-to-date gains up to almost 6%. Let's get into some of the economic data released last week. We start with consumer credit. Consumer credit for the month of July rose $16 billion. That was way above the $10 billion estimate. A huge amount of that was due to a massive rise in revolving credit or credit card debt. Biggest monthly gain this year. Online retailers were the beneficiaries of that, but so were furniture stores. Furniture stores suggest confidence on the part of consumers. This is not something that you buy in an emergency. This is when you're confident you'll be able to pay for it as a general rule. Automobile sales and the debt associated with autos also climbed, suggesting a stronger consumer. However, there was an increase in delinquencies, but that was largely centered around student loans. So we might be seeing a divergence between maybe older and younger borrowers. It's widely talked about now, the amount of debt that college kids are entering the workforce with that is quite large relative to their earnings prospects. We move on. We got August National Federation of Independent Businesses Small Business Optimism. It rose again from 100.3 to 100.8. That exceeded expectations. Within the respondents, the sentiment survey found out they expect higher sales ahead, but they still are a little bit elevated on their readings around uncertainty, concerned about probably input prices and wage prices more than anything else. Speaking of prices and inflation, we had two very big reports last week for the month of August, one for producer prices, the other for consumer prices. Producer price index for the month of August fell 0.1%. The estimate was for an increase of 0.3, so the markets really welcomed that. That seemed to give the Fed the all clear to possibly cut rates coming up this week. Inflation there is up 2.6 on a year-over-year basis. Producer prices often lead consumer prices. So I'll show you in a minute, we did not get a similar result from the CPI. It is still considered a strong positive by most analysts, the number we got for PPI. Core PPI, more important, also fell 0.1% and is now up 2.8% year over year. Remember, the Fed's target for core inflation, they use a different gauge, core PCE inflation, but that target is 2%. So we're still well above that number. So a lot of folks would argue the Fed should not cut rates next week until such time as there's clear visibility to core inflation getting to 2% or even actually waiting until it actually hits 2%. We move on to CPI. Here the numbers don't look quite as good. They're not horrible, but they're not quite as good either. You see in the chart over here on the right, you can see it's really kind of extending higher, and that is worrisome. The CPI for the month of August was up 0.4. That was above the 0.3 expectation and is at 2.9. That's well above the 2% target. Core CPI, more important, also gained 3%. Here we are above 3%, so clearly well above, again, the 2% target. Yet, at the same time that we saw this, we saw a very unfortunate spike in initial claims for unemployment. Now, to be sure, anything below 300,000 shows, in my mind, is still considered a fairly healthy labor market. We rose to 263,000. The estimate was 235. We had the 4-week moving average, you can see, moving up here and to the right. None of this is good. However, one state was a big component of that. It surged 15,000, so part of that delta, an additional 15,000. Most other states showed a modest decline. WARN notices of impending layoffs, did not rise nationwide. Continuing claims also unchanged and still below that psychologically important 2 million level. So is this time to panic? No. Is it great news? Absolutely not. So the Fed is sitting there saying, well, we've got potentially softening economy. We're seeing a pickup in weekly claims for unemployment. We've seen multiple months in a row of weak job growth, no job losses, but weak job growth. Should we get ahead of this and just assume that inflation is going to continue to come down given the softness in the labor market and other areas? Or should we wait longer before we start cutting interest rates because we do have this overriding concern about pricing pressure? It's a very difficult decision that they're going to be making. That decision is going to be made starting tomorrow with an announcement for all of us to see at 11 a.m. on Wednesday. Speaking of that, we will then post-Fed announcement have our quarterly conference call for all of you to attend. Please register on our website. University of Michigan's consumer sentiment reading fell again from 58.2 to 55.4. These are pretty low numbers. The consumers are not feeling particularly good. You have to go really back to COVID, and you can see the COVID numbers were actually even higher than they are today in terms of consumer sentiment. Current conditions continue to deteriorate. Expectations have declined significantly to 51.8. They're very concerned about the labor market. Despite that weekly number having sort of explanations to it, I'm hearing anecdotally about layoffs. Just hearing it out in the community and talking to people. So the labor market is for sure softening, and that is weighing on people's economic outlook. So as I mentioned, the Fed is meeting this week, Tuesday and Wednesday. They are anticipated to cut interest rates by 25 basis points. Remember, the Fed only cuts one rate, well, two, the Fed funds rate and the discount rate. The Fed funds rate is the one that matters for this particular discussion, and that would bring the Fed's funds target rate to 4.25 from the current rate of 4.5. To be sure, ultra-short interest rates are above a lot of the rest of the yield curve. There is a slight inversion to our yield curve. That suggests that the market has lower inflation expectations, and therefore it suggests that the Fed could easily cut those short-term interest rates. On the other hand, we have the aforementioned problem with sticky inflation. I think a lot of the sticky inflation is driven by excessive federal borrowing, driving up interest rates, driving up inflationary pressure with these 6 and 7% fiscal deficits. So, to cut rates next week, I would say it is a risky move. It may be the right move. This is going to be debated by the Fed governors, but it is still risky given the fact that inflation remains elevated. But to not move is also risky because the labor market has softened. It's very clear now. It's almost undebatable. The efficacy of the Fed's moves towards inflation using this tool of the federal funds rate, though, I think is called to question. We should call this to question because the Fed is not pointing the finger back at the Congress saying, hey, well, if you weren't borrowing so much money and accumulating so much debt that has to be continuously refinanced, we may not have the inflationary pressure that we have today. So there's a lot of concern there, a lot of debate and discussion there. So the Fed meets, as you know, as I said, this week. We'll have Wednesday, likely, according to the futures markets, Fed funds futures market, one cut. One cut equals 25 basis points. So there's a modest chance it could be more than that. And then again in October, 2, so the 1.8, so it'd be another 1 or 0.8, almost basis points from today. You can see by the end of the year, we're expecting about 3 cuts. Well, there it is, 3 cuts, and then maybe another one as early as January. So this is part of the reason the equity markets are going to all-time highs. They're loving the Powell put, the Fed rate cuts. Inflation can manifest itself in asset prices, so people are excited about owning stocks. They're excited about owning real estate. If you don't own any of those things, then the rate cut just means more inflationary pressure for your consumer products, goods, choices. And to put it all in perspective, the United States of America has a very, very big debt problem. We have over $30 trillion in outstanding debt at the federal level. There are 4,400 different bond issues outstanding, with an average weighted coupon that's actually surprisingly lower than I'm sure anybody thought. Because we had ultra short interest rates for so long, remember the financial crisis of '08, and then we had the COVID crisis of 2020, where we artificially depressed interest rates in order to stimulate the economy. The federal government also borrowed massive amounts of money at those very low rates in order to stimulate the economy, in order to put it back through fiscal stimulus. That debt is sort of coming due. And what do we do about it? The administration is attempting to outgrow with massively pro-growth economic policies. We've got an average maturity of 2031, which is only 6 years from now, average weighted about 5.8 years. So this chart I put together this morning, this blue line, you've seen me give this many, many times. This is the debt to GDP of the federal government, of the United States Treasury. We're at about 120% debt to GDP, and that absolutely it just must come down. However, on the positive side, if you wanted to be the glass is half empty, this is consumer debt to GDP. You can see consumer debt to GDP is only about 67%. We haven't been in that low level here for over 25 years of consumer debt, which means that consumer balance sheets are incredibly strong. And if rates come down further, and that encourages even more consumer activity, and that could include buying homes and mortgages, and people are waiting for that to happen, that could stimulate further growth in the overall U.S. economy. Speaking of mortgages, speaking of residential mortgages, we have seen rates here start to come down. This is the bank rate 30-year average mortgage rate. You can see coming out of COVID, 5.5%-ish, right? Or here we are, coming out of the global financial crisis, we got down pretty darn far. We kept rates lower and lower. We got about 3.5. Then we came into COVID. We got rates down well into the 2s on a 30-year mortgage. It's a once in a generation, maybe once in history type of occurrence. Then we had the mass run up in inflation, which shot mortgage rates very high, over 7.5%. But they are now down, as you can see here, as of this morning, to about 6.4. From a long-term historical perspective, not from the last 20 years perspective, from a long-term historical perspective, they're really not that high. The question is, when the Fed cuts, if the Fed cuts the Fed funds rate next week, I think they will, how much of that will translate into lower 30-year mortgages, or is it already priced in and 643 is about as good as we're going to get, at least for the time being? As I've said over and over again, I think the biggest contributor currently to the inflationary pressure is the massive outstanding debt of the U.S. Treasury and the continued implementation of very high deficits, 6% of GDP as an example. Here's a quick couple of pie charts on the drivers of the federal U.S. deficit. You can see, there we go, the federal deficit here. 50% of this is the entitlement spending. That's the Medicare, Social Security, trust funds. The administration is going to great lengths to try to eliminate, there was DOGE and so forth, but not to eliminate people that are entitled, but to make sure that only those entitled, only those who have paid in and contributed are taking the money out. That may help a little. Interest on the debt is out of control. That's contributing massively. Defense spending is contributing, and other discretionary. But when we talk about federal spending, when the Congress debates and comes up with a budget that ultimately the president signs or vetoes, what's really under discussion? Well, entitlements are mandatory, and they're not really part of that budget discussion. So 62% is already off the table to begin with. The two sides generally agree within a small window, but they generally agree on defense spending needs to be massive, and it is massive. They really don't get to say a say on the interest cost. The market determines the interest cost that the Federal Reserve, that the U.S. Treasury must pay on its outstanding debt. That explains why you hear the president constantly jawboning and trying to pressure the Federal Reserve to lower rates, because that could translate into lower borrowing costs, allowing the federal government to refinance some of its debt. That might help on the budget. So the real debate among the two parties in the Congress is over this 10% of federal spending. So we make a big deal out of it. And even if we eliminated all other spending, we could only cut 10% of spending. So you see, it has to come from reforms on entitlement, interest rate, but you can't control that. And if you cut defense spending, you weaken your position in the world. And so we are in a very, very difficult spot as a country. This week's economic data includes New York State manufacturing. That's today. That's Monday. Retail sales, import, export prices, industrial production, utilization, business inventories, and housing sentiment expected to continue to be absolutely miserable. Housing starts and permits expected to continue to be low, but the market's still at an all-time high because we expect the Fed to cut rates. Weekly initial jobless claims expected to come back down to 245. That will be welcome news for sure. Philly Fed survey, and then Friday, not anything going on. Thanks for tuning in. The name of this podcast is Slaying Bulls and Bears. I aim to make the complex and complicated very simple and very sensible. This is available weekly on all of your podcast formats that are audio, and on one that is video, that is YouTube. You get all the graphs and charts, and you get to see my smiling face. Thanks, everybody. I will be back to you again 1 week.